Welcome to Total Money Management. Steve and I are back again. We're covering topics from the 18th to the 22nd. How you going, Steve?
Good, mate. Good.
Bloody
Getting
rains.
a little bit of Santa rally, little bit of Santa vibe.
Oh, never mind Santa. I've been trying to play golf for a week and I can't because it's bloody raining.
Oh, really?
Yeah.
Well, I know it's raining.
You're blind.
This is Christmas golf.
Yeah. Oh, I'm looking forward to a break. Anyway, look, this week, not like you.
Yeah.
Look, this week we'll cover the big issue in a second, but we'll get through the week that was. I think we're going to spend a little bit more time on the lesson of the week as well, towards the end.
Yep.
But I wanted to give people some actionable insights or thought principles to ask themselves in an overpriced market. We talk a lot about the market being overpriced, and we know that people are getting a little bit long in the tooth at it. So,
You got anything new to add, Steve?
so let's try and create some. Well, just give people some actionable principles they can talk about. So the chart towards the bottom here, and we're expecting you guys, if you listen long enough, you've got access to the week that was. So we'll also get it up here. But the chart that we're using at the bottom here is used for scale. It's always difficult to stand back from the current mayhem to see if you can determine what's actually going on.
Yeah.
But I wanted to just the 7 questions here, which I'll run through, and you can maybe give us an overview on what questions to ask yourself before you're going to invest in a market.
Yeah,
So
especially when it's this crazy, because it always, I think it was Buffett, probably was, the old bastard said everything, it's easiest at the top, or it looks easiest at the top, right? You just buy stocks and they go up. You just buy Bitcoin, it goes up. Or you just buy a property and it doubles, you know? Like that's the deceptive part of investing. Because it's also generally at the top when you're getting the lowest yield. So it's actually a bit like, oh, dude, you know you're getting the lowest return there. It's like, I'll be all right.
Well, it's classic groupthink, though, right?
Yeah.
Like human beings are generally sheep, and we look at to see what the herd are doing.
It's safer in a crowd. And it's very few people. If you say to yourself, listen, I don't know that much about the stock market, what you generally do is go, but everybody else is buying stocks. Must be something in that.
Must be right.
Right? Rather than saying, listen, I know what I'm doing and those people are making a mistake. You know, that takes a certain level of, Seth Klarman said, you know, it takes a certain level of arrogance to be a value investor, because what you're sort of saying to other people is, dude, you're wrong.
Yeah,
I'm right. And, you know, that can be very risky to reputation, but also just your own way of thinking, because the market goes on a lot longer than you think, and you get to a point yourself where you go, well, maybe that cape's not right anymore.
Or we can use ourselves as a good example. We're contrarian investors, right? And we get so much flack for it on the socials and emails that come through, and we're okay with that. But it's difficult. Imagine you being a contrarian by nature, but not an investor.
Yeah.
You're trying to get into investing, and everyone's telling you the opposite of what you're actually thinking.
Absolutely.
So anyway, the couple of questions here. The first one being, how much longer can the US market continue to rise? Second one being, at what point does it revert to the mean? And we talk about mean reversion throughout the things that we teach. Number 3, how does today compare to the historical averages? So the price today versus the historical average. Is anything different today to justify today's valuations? What do you mean? What do you mean? What do you mean by that? Just to simplify it for people.
Well, just what happens, you know, the funny story, you know, this time is different.
Yeah.
And what I think I said last week when you and I were talking was, there's always something different, right? And it's generally based around economic reform or, technology, right?
Yeah.
Oh, we got the internet. Woo! You know, we've now got railways. Wow! You know, now it's AI.
Yeah.
Oh, we've got AI and it's going to take over the world, and you're not going to unbelieve. It's going to be a head spinner, you know, blah, 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 right? Exactly the way the internet was. Yeah. But what I'm trying to reinforce there is this idea of, yes, we know that. But what I'm saying is, we knew that 50 years ago when railways were the latest innovation, or we knew about it 70 years ago when aeroplanes were an innovation. We knew about it 25 years ago when the internet was an innovation. but the market still went up and the market still crashed, and it was because it was overbought and it got oversold. And so what I'm saying there is what you need to do as an investor is take yourself out of the hype and ask yourself those questions in a logical manner, right? So how much longer can the US market continue to rise? Oh, man, it's going to rise forever, right? It just always goes up. Someone on our socials wrote, we're not going to have the dip maximum will be 15% and, it's going to go up and it's going to go up because of this and because of that, blah, 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 right? And that's why I'm saying you've got to take a step back and look at history, but also dig deeper and say, okay, well, when does it mean revert? I don't know. Okay, well, gee, should I have a lot of money in the market if I don't know about mean reversion? What does it compare to historical averages? Oh, what's historical averages? It's like, okay, there's your starting point, right? Go back and look at CAPE. What's CAPE?
Yeah.
Right? That sort of stuff. Is there anything different today to justify today's valuations? Go and Google economic history and read even one book like Robert Schiller's Irrational Exuberance, right? I can tell you, mate, this has all happened every time before, right? Every era. Robert Schiller, I think I mentioned it a while ago, Chapter 6, I think, is New Eras, New Era Thinking, right? He wrote the first edition when the internet was blooming and the second and third editions when it was busted.
Yeah.
Right? And that's what I mean. It was like, everyone was like, oh, the internet's going to change the world and nobody's going to go to the pictures and nobody's going to shop anymore. And, and it's a bit like, nah.
Yeah.
And
it changed the world, but the market still came down.
Yeah. Right. Absolutely. And that's what I'm saying. What you do is, and I think we said last week, people start to go, oh, yeah, CAPE, but the last 25 years it's been 25 average, and that's because of XYZ. And it always keeps coming back to what you find is everybody's trying to justify batshit crazy valuation when it's easier just to go, listen, mate, everybody's in the tent and they're all crazy and drunk.
Even if you use the last 15, 20 years where the CAPE's been over 25, it's still at 38.
Yeah. So, hey, dude, use 30, it's still 28% overvalued, right?
Exactly. So you can cut it however you like. It's still expensive.
Yeah.
Even if you cut it to 12 months.
Yeah.
It's like, it's the highest it's ever been.
Yeah.
Okay. All right. So,
Number 5.
What do I know that other people don't?
Yep. So that's, again, where we talk, when we talk about the session on risk, I'd say there's 4 parts to risk, right? Personality, your personal circumstances, and the second one is market knowledge, right? What do you know about the market? Because if you don't know that much, you'll probably get your fingers burnt, especially if you don't know that much and you don't even know that you don't know that much.
Which is usually the case, right?
Absolutely, because what happens, Jacob, is a lot of people get in once the market's boomed, right? That's not all the time, but generally that's the part that says you should have been here in 2009 when the CAPE was 13, not when the CAPE's 38.
Well, I can use myself as an example. Getting in 10 years ago into why would you do something that – so this is the way I think about it. Why would you do something that was boring? You wouldn't even know it existed if it was boring.
Yes.
So if the market's booming and you go, oh, shit, that looks all right. So I did the same thing 10 years ago. Oh, that looks all right. I'll get in. And it was a market top.
Yep.
So lost a shit ton of money.
Yep.
But then you go through this learning phase over the next 2, 3, 4 years where you're like, okay, that's why you gather your market knowledge. That's why I lost all that money. And then you go for the next run.
Yep.
So I think it's pretty normal where new investors, new blood get in at the top of the market. They're all going to lose money.
Yes.
But if you stick around for the long term, it comes back again.
Yeah. But the funny thing is, and this is why I say, if you don't know what you're doing, you don't have a system.
Yeah.
If you don't have a system, you don't really know why you bought stocks.
Yeah.
Now, the real problem is, and you don't know when you got to sell them either.
Yeah, that's the
right?
hardest part.
Because the higher it goes, the better off you think you are, the more likely you're actually going to cop it.
Yeah.
Right? But you don't know that because you don't know what you're really doing, right?
Yeah.
You're just following others.
You start to think you're a genius. Number 7, last one. What is investor sentiment like?
Yeah.
So,
and
what's the overall market sentiment, basically?
Yeah. Well, if you look around, and this is why we're saying we'll talk a bit more about some other stuff, because if you look at the investor sentiment ratios, everybody's in the US. The US is now 75% of the world market cap.
That's crazy, isn't it?
That is absolutely nuts, right? And that's why I'm saying to people, well, you need to be goddamn careful.
It's like you putting 8 eggs in one basket.
Well, it's like putting 11 in one basket, right? Because that's a hell of a basket, and it's sitting on the edge of the table, and there's 25 toddlers in the room, right? Best of luck. But in all seriousness, what investor sentiment? What I've tried to do there is, if you look at the top 3 or 4, they're the numbers, right? What's the CAPE? That sort of stuff. The bottom ones are, what do I know that other people don't? What do others know that I don't? And what is investor sentiment? They're the behavioural aspects, right? So you've got numbers and narratives, right? What are the numbers? Awful. What's the narrative? Fantastic. Okay, that usually leads to a bad return.
Red flag.
Yeah. And so, the numbers can be terrible, and the narrative can be really positive, which is fine. You can get that when the CAPE is low, the market starts to pick up and people go, hey, things are starting to look a little bit better. It's not too bad. Well, that's okay because the CAPE's at 12.
Yeah.
So that's justified by saying, okay, we probably got a good runway here.
Yeah.
38's another story, right?
Yeah. No, I think that's a great point. Moving on to Monday, what we got to hear, so on the sentiment part, consumer sentiment by party can't even read that, money in my glasses. Identification.
Yeah, sorry. It's just what it shows is if you have a look at the election, what happened was all the Republicans said the economy's crap before the election.
Yeah.
Donald was re-elected and then they went, things are pretty good.
Oh, yeah. Which happens every time.
Yeah. It's just what I'm doing there is I'm just trying to point out to people that we're all really fickle, right? And we all want to justify our own positions, right? We all want to talk about my beliefs are the way the world should run. I am absolutely shocked at how many people on Twitter know how to run a country.
Yeah, that's true.
Right? It's mate, and I'm not kidding, it's so bloody simple.
Yeah.
Right? None of these blokes have ever had to deal with democracy, right? Like they obviously, when they have their family, they just walk in and make a decision, and the waves part.
Yeah.
Right, and it's perfect decision,
and everyone pretends to be happy.
Well, yeah. I mean, as I said to you, I've been in politics, mate. You try and deal with stakeholders. It's really, really hard, and everybody shitsbags politicians for it, but nobody does that job. Right, like in the sense of you walk a mile in a man's shoes, as the old saying goes, right? And then you start to get the idea that it's not just walking in there and telling people what to do, buddy. That's not democracy, right? I can't remember. I think it was some baseball player, can't remember, who said, I never realised batting was so easy until I got in the commentary box, right? Because all the commentators can see what they're doing wrong. And they've never swung a bloody bat in their life.
Yeah.
And so it's just this stuff of how we look at the world. And that's why I say, when you look at markets and you've made a lot of money, you seldom go, I need to be really careful here. Mm-hmm. What you do is you go, yeah, it's all great. It's all fantastic. In fact, I'm doubling up. I'm going to leverage up, right? Because, you're reinforcing your own genius.
Yeah. I mean, I suppose this chart as well, we just need to take it with a grain of salt. So to get Trump elected, when he needed to create a certain narrative which would get people away from the other party.
Yes.
Now Trump's been elected, it's okay, the market's all right.
Yes.
But actually, no one's showing us the numbers.
Well, funnily enough, a lot of Trump voters didn't realise that they're going to evict a lot of people that pick fruit and vegetables and what's the other one? The food industry has gone, holy hell, we rely on illegal immigrants. And there's another industry that escapes me. But a lot of Trump voters are now going, oh, you mean our fruit and veggies are going to cost more? And it's like, yep. And the same with the tariffs.
Well,
right?
We'll cover tariffs, I think, next week, because I think that's one of the big issues for next week. But it's batshit crazy. They're tariffing their neighbours now.
Yeah. So look, it's you know what, Jacob? We're our own worst enemy.
Yeah.
Right? We're our own worst enemy because sometimes we get so blinded by beliefs that we do something you know, and I'm not saying voting for Trump is wrong, but you do something like Stanley Druckenmiller, right? Sold all the internet stocks in 1999 and went, I'm a genius. In 2000, he went, this is painful. Goes in again and loses like $3 billion or something, right? That's what I mean. You do stuff where in your cooler moments you look back and go, what the hell how did I possibly think I was going to make money doing that? Yeah. Right? How could I possibly vote for Trump when now I understand the tariffs are going to make everything more expensive, right? It's just like, well, you know, that's the way it is because you have these emotional beliefs and come hell or high water, you're going to, you know, validate them, right? Confirmation bias.
Yeah, right? Yeah. Tuesday, so we've mentioned this a few times, but we got the likes of Buffett, Bezos, all selling their stocks. Insider selling is going through the roof.
Yep.
So, I mean, take it.
Yeah.
It's an obvious one.
Ding, 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 ding.
Maybe don't put all your money in at the minute.
Yeah, it might be a good idea.
Wednesday, everyone's feeling pretty good about stocks. So we've got the US Economic Optimism Index. So everyone's thinking that
it's all great
and it's going to be okay. That's a red flag in itself.
Well, 2023, it went up more than 20%. We're up more than 25 in the S&P, I think.
Yeah.
So 2 years going up 20%, you know, things are like you're looking at that and it's hard to listen to blokes like us go, mate, you need to be careful.
Yeah, I can understand why people reach out calling us dickheads. Like,
well, calling you a dickhead. I mean, they think I'm great, but
it's usually you, mate. But like, big red flag. Like, if you think about groupthink and herd mentality, if everyone's saying one thing, then
well, it can't go on forever, no. Right? You know, gaining 20% per year means it doubles in 3.5 years.
Yeah.
Right, so that means and you know, I think we're talking later on about, you know, people are coming out with 2025 predictions, and what are they? None of them are bad, right? They're all 20%. Like, we're smashing it out of the park. It's all going to be great. And look, you know, as I said, it may well be, but it doesn't mean that you should be all in. You know, if you know what you're doing. Okay, you might know what you're doing. That's fine. But if you're sort of just following the crowd, be a little bit careful.
There's nothing wrong with having cash.
That's right.
Thursday. So we talked about this, I think, on the socials a couple of days ago, which is the NASDAQ being so far. Oh, no, this is not. This is the US being so overvalued compared to Europe. But
yeah.
On the NASDAQ, it's so overvalued compared to the Dow.
Yep.
And the last time that happened was about
2000
when everything came back. But this chart's saying the last time the US market doubled in 4 years was 96 to 2000. Then it proceeded to lose 50%, with the NASDAQ losing 82%. So over the next 3 years. So we can have big drawdowns.
Oh,
it's
yeah,
not
absolutely.
Little 10 or 20%ers that you see in a bull market. We can have significant drawdowns.
Yeah, absolutely. And the bigger the gain, the bigger the drawdown.
Yeah.
Right? That's, again, if I use the simple analogy of, you know, people walking in the room, men walking in a room, right? If a guy walks in who's 7'5", you're not going to say, well, that's it. They're all going to be 7'5" from here on in. What you know is with mean reversion is they might not necessarily be 4 foot, but it might be 7'5", 6'8", 6 foot, 5'7", 5'5", right? It doesn't have to be swift, but what we're saying is it will mean revert. And if it mean reverts and the average dividend is 5 and it's currently paying 1, that means the price is really expensive.
If you've bet on the next 10 people to come in to be 7'5",
you're really asking for it.
Yeah.
Yeah, and that's what I'm trying to point out there, that, you know, the higher it goes, the worse the fall, right? And we know that. And we're just saying, well, the cave's at 38.5, and historically, in relation to history, it's now basically the most expensive it's ever been.
Yeah, just explain that.
Well, you just you adjust it for inflation and stuff like that.
I see. Right.
And so you look at it and go, it's way past 1929, and it's now toppling over 2000.
Wow, so the CAPE adjusted for inflation compared to the 2000, which was 44.
44.
It's actually higher.
Yep.
Right.
And in 1965, it was about 26. And in 1929, I think it was about 28 or so. But what you see, Jacob, is about 24, 25 is when you've got to start, you know, paying attention, so to speak. Now, people will say, oh, man, it's gone up to, 38. Like I didn't get out at 25.
No.
Right? You just adjust your allocation.
Yeah.
You will still make money. Right? You will still make money. You won't make 100,000 like Jacob made, but I made 42.
Yeah.
But in 2 years' time, Jacob's 100 will have turned into 50 and my 42 will have turned into 64 because I avoided the big losses.
Yeah.
Right?
Yeah.
That's the way it works.
Yeah.
Right? That's why rebalancing is really, really critical around the top of the market.
And
right?
Having the right strategy for the right market cycle environment, which we'll talk about in a minute.
Yeah.
But just on Friday, we've got these two charts here. So the more people spend on rent and mortgage payments means less money goes into economic growth. So we're seeing economic growth, particularly in Australia, not really go anywhere. It's doing okay in America.
Yep.
Which I think is, in my mind, it's adding to the issue.
Yeah,
economic growth in America,
Yeah.
it's adding to everyone's issue.
Absolutely, because the economy's doing quite well.
Yeah, and they're like, economy's doing well, so the stock market must continue to do well.
Yep.
As we know, they're not the same.
Yep.
But Australia's a bit of a different story.
Well, because the government is not spending enough money to stimulate the economy. And so what we're relying on is private borrowing. Now, private borrowing can be investment for business or people borrow. But people generally borrow, the public generally borrow for unproductive reasons, right? So you borrow to, stay afloat, or you borrow to buy a car. Well, a car isn't a productive asset, nor is a property, right? So what you do is you say, okay, well, really there's only business investment and there's government spending, right? And you could call government spending investment, right? You can argue about that, but it's generally other than Social Security. So why would business invest if the economy's running at 1%? We're basically in a per capita recession. So I come to you and go, Jacob, I want you to borrow, $500 million and, build a widget factory. You're going, what for? Nobody's buying widgets. Well, why would business invest? The only investment we're doing here in this joint is mining. Because we're digging shit up and sending it overseas.
For now, without
yeah. So, but do you see what I mean? You've got to keep money going into the economy, and if it's not going through higher wages, or if your existing wage is being eaten by more rent and more mortgage payments, then there's less money for the economy, and this is the problem Australia's got. Right, but as soon as you talk about wages or government spending, all these idiot economists come out and carry on about inflation.
Yeah.
Right, and go, it's all wages, it's all government spending. Well, no, fellas, it's all bullshit. It's companies that have got a lock on the market. That's what's going on. And the thing that you won't hear about, which you used to hear about in the 70s, was productivity. Well, if prices are really expensive, you tell companies to get their adopt new technology to start driving some, cost effectiveness. All they do is sack staff.
Well, on that point, so I was talking to, I won't name drop, but a pretty established CEO a couple of days ago, and they, I don't agree with what they were saying, but they were saying, look, there's such lack of productivity in the business. It's been such an employees market for the last few years, and
3 out of the last 40.
Yeah,
bastards, you've never had it so good.
And they're like, we've got so many basically dead staff. So they're like, in the next 2 years, I'm sacking 20% of my staff.
Yep.
I was like, shit, like, what's that going to do for your productivity? And she was like, I don't care. Like, we need
not the shareholders.
I need new people.
Yeah.
So I was like, it's interesting because can they be replaced with people that are more hungry? And you can argue that that's the case.
Yeah, the argument is, in terms of productivity, is what you do is you adopt technology, which is, a few things. You can make a better process, right? Which was what the Japanese took on with what they call Kaizen, right? Which is incremental improvement, or Deming. Deming created this way of making stuff, right? Like Adam Smith's pin factory. You just make this bit. Don't worry about all of it. You just make that bit. So Kaizen was that sort of just in time and all this sort of stuff, right? Took over manufacturing, right? Swept the world, mainly because of the Japanese. So what the idea was, well, that's one idea. Now, the other idea is you go, Jacob, Jacob makes pins. Okay, well, I'm going to sack Jacob and I'm going to employ a machine that makes pins. Jacob makes 100 pins. This machine makes 1,000 pins, right? So I'm going to give Jacob the flick and I'm going to put in the robot that makes 1,000 pins. You're then freed up to go and do, other areas or other things. And that's the way you increase productivity. But what we've found over the last 30 or 40 years is because wages are not rising, there's no reason for the bosses to go, man, I got to get Jacob out of that bloody pin factory, right? Because it's like, who cares? Jacob's only earning 2 and 6, and if I don't like it, I'll sack him and get someone else.
Yeah.
I mean, look at coffee shops and the service industry. It's notoriously unproductive, right? Because at some point you can't say, I'll just get one staff member to run the whole bloody show. You just can't do it, right? Whereas in manufacturing, you can be productive by, new technology, new processes, all that sort of stuff.
It's a vicious cycle. You end up sacking the people that are unproductive and overpriced and getting younger people with less experience, which provide a worse service.
Yeah, yeah.
And you're caught in this cycle then.
Yep.
And you can't grow because of it. Anyway, we won't get on to business. Bonus section. So Australia cumulative wage growth versus housing price. We've mentioned this a few times.
Yeah.
We know house prices are fucking stupid in comparison to wages, and we know that people's savings accounts are being dwindled based on people in the industry telling us that they are.
Yep.
And there's a huge imbalance. So there's been a bit of a wobble in housing, but we don't really talk about the micro movements.
Yeah, the thing I'm just pointing out there is if you take a mortgage, you have to the mortgage repayment comes from your wage.
Yep.
Okay, so there has to be some relationship between wages and the mortgage, and that bit is the ability to pay, right? So, for example, you can't go and get a $2 million mortgage on a wage of $50,000.
No.
Right? Why not? Because the repayments.
You can't pay it.
Right? Okay, so there's your relationship. Now, when you look at it and say house prices are going gangbusters, but wages aren't, you have to say, okay, well, something's not right there, right? Now, is it house prices or is it wages? Is it a combination of both, right? So what I'm pointing out there is we've seen this in other countries, and logically you just realise that house prices are being speculation, right? People are just buying houses and speculating and taking up more and more of their wage to try and gamble that they're going to hit rich and, buy $1 million property and sell it for 1.4, right? And they're going to save as much as they can to get into that mortgage. But that's not the point. The point is that, like we talk about 40 years ago, you could have a house, you could have interest rates at 13% because the house was, 100,000, right? And your wage was lower, but it was 4 to 5 times income. Yep. Now it's 13.
Yeah, that's
the point. And that we have to think about if we're going to end up like Japan, where we basically get 25% of the population that owns all the property, and the rest of us just rent for our lives because there's no way you can get in.
There's an interesting point on socials, which I thought about for a couple of days, where someone basically said, we need to, if you can't afford to live in the major cities, move out, basically. We're going to end up like London, or we're going to end up like living in Madrid or something. And I was thinking, it's a fair point, but what Australia's a bit different because 95% of the population live in the
cities anyway.
In the major cities.
Yeah.
So it's not as if you live in England where you've got 66 million people and you could live anywhere you want.
Right. Australia's 80% live within
we're very
10 mile of the coast.
We're very condensed into certain areas.
Yes.
So it's a valid argument, but unless you give us 500 years to build out the middle of Australia, it's probably not going to
happen.
Sit. So it's conscious that we can't think of it really that way. You can move out to Toowoomba or something. You can move out somewhere else, but it's still with a couple hours within a major city.
Well, yeah. How many architects live in Toowoomba?
Exactly. Yeah.
So it's easy to go. I just moved to a regional area. It's like, okay, I'll move to Dalby. It's cheap there. Okay, what would you do at Dalby? Oh, nothing, but it's cheap.
Yeah.
I mean, you can't really. There's a reason why we all live in cities, because we like living in cities and we like being around and having 10 coffee shops and hospitals and.
Or it's the wage and price thing. Like you live in Dalby, the wage will come down. It's still probably still 8 times your wage
income. Yeah, and there's 4 jobs.
Yeah. So it's just good. It's good. It was a good question. It's good to just contextualize it.
I think that when we'll talk about this more in the property special. I'll leave it for that.
Okay. Short story. What we got here? Basically, things been overpriced.
Everybody's into crypto. Everybody's into large caps. Everybody's into everything. It's just all fantastic.
I love it. Let's talk about the lesson of the week then.
Let's just bring this back to reality.
This seems to be a very popular one now. You got rid of the chow, and it's now the lao.
The lesson, yeah, it's now the lao. I'm just pointing out here. This is 2002, right? This is a cape at 44 to a cape at 23. But what I'm pointing out here is...
So 44 here, 23 here, right?
Yeah. So it's also the same for 2007 to 2009, right? Cape from about 28 to about 12 or 13.
Yep.
But this is my point. You get these black lines, right, these rallies, where at every point you're going, man, we are so back, right? And then it falls again. Right, then we get another rally. Now we're back again. We're on again. Now, to belabor the point, that's a 3-year chart. And if you didn't know about Cape, tell me where you get back in. Right? Because behaviourally, I'll tell you, you're looking there going, oh, man,
you get in here,
there's a 20% bounce. I better get back in again.
Yeah, and then you lose.
Everyone on the telly is going, dude, you got to get back in again. Where everything's looking good again. The government, blah, 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 right? Yeah. Oh, you got to get back in. Meanwhile, it just keeps going lower and lower.
Yeah.
Right? Whereas with a Cape ratio, you can look at that and say, and I'm not saying it's easy, but you can look at that and say, I'm not buying it. You think the Cape's 44. If it drops to 34, it's like 20%. That's the time when you're going, 20%, bear market, time to start buying.
Then it goes to 24.
Then it goes to 24 and you go, oh, man, now I'm down to like 30%.
Yeah.
Right? That's what I mean. Look, I'm not saying it's easy, but I'm just saying you need to be aware of the longer-term indicators if you're a longer-term investor. Like, well, one, I won't bore you, but that's quite good. You look at it and go, great, I'll take those rallies. But when you're a long-term investor, you've got to know about valuation and patience.
So I think that's a good point that you mentioned, though, Steve, because we harp on about it a bit, but this is where it pays to map the right investing strategy to the cycle of the market.
Yes.
Into the value of the market.
Yeah.
So we're looking at something like this. We're not thinking necessarily well 2, well 3, and we're just talking our terminology. So you can put whatever you want to it. We're thinking about well 1. Yep. Okay, so Cape's here. We're going to have some pretty significant rallies which we can capitalize on, and we can get in and out of the market relatively quickly.
Yes.
Well 1. If Cape's down at 20, 15, whatever it is, we're thinking, okay, well 2. Bit of a mid-term strategy into feeding your long-term strategy. We can adjust the asset allocation for that.
Exactly. So. That's the reason why. It's just because I just got a feeling we might be getting another one of these soon. I might in 3 months you might go, Steve's a genius. Look at that, the bear market rally at the top. But anyway, it just again. Look, as we said at the start, everything's crazy expensive. You just need to be careful. If you want to make money over the next 2 weeks, by all means, go for it. But just be aware that these things can turn on a dime. It doesn't need any specific, ding-ding event where you go, oh, my God, World War III started. It can just turn. Right?
Butterfly effect.
Well, yeah, absolutely. Right, is that it, Jacob? Are we done?
We'll see you next week, eh?
We've dedicated
Actually, before we go that, we've got a property special coming out, which will likely be between this one and the next one. Just for your listeners.
December 11, folks.
Thanks, Steve. Cheers, guys. See you soon.
Cheers.
As always, remember, we don't provide financial advice.